Welcome back to the channel, where we break down everything happening around XRP with precision and clarity. Today's topic is something most people are underestimating, and if you're not paying attention right now, you might completely miss what's unfolding. It will be very hard to get XRP, not later, not in some distant future, but potentially much sooner than the majority expects. And this is not hype. This is based on a combination of supply mechanics, market behavior, institutional positioning, and the way the digital asset space is evolving globally. Right now, most retail investors still think XRP is just another coin sitting in the market, available anytime, anywhere. But that assumption is slowly becoming outdated. When you start looking deeper into how XRP is structured, how it's being positioned by Ripple, and how liquidity corridors are developing, you begin to realize something important. Availability does not always mean accessibility. There's a difference between XRP being listed on exchanges and XRP being easily obtainable in large quantities when demand spikes. Let's break this down in a clear narrative way. XRP has a fixed supply, 100 billion tokens. A significant portion of that is locked in escrow, controlled by Ripple, and released gradually. Another large portion is already held by long-term holders, institutions, and early adopters who are not actively trading. This creates what we call liquid supply pressure. In simple terms, even though XRP exists in large numbers, the amount actually available for buying at any given time is much smaller. Now combine this with increasing global interest. Cross-border payments, remittance systems, and liquidity solutions are areas where Ripple has been actively building. The more adoption grows, the more XRP gets used as a bridge asset. And when an asset is being used rather than just traded, it starts getting locked into utility cycles. That means fewer tokens circulating freely in the market. At the same time, we're seeing a shift in how big players approach crypto. Institutions are no longer ignoring digital assets. They are entering strategically, and when they do, they don't buy small amounts. They accumulate quietly, consistently, and often before retail even realizes what's happening. If institutions begin targeting XRP for its utility rather than speculation, the available supply on exchanges could shrink rapidly. Another layer to this is regulatory clarity. For a long time, uncertainty around XRP slowed down broader adoption. But as clarity improves in different regions, barriers begin to disappear. And when barriers disappear, access increases. But here's the paradox. As access increases globally, competition for the same pool of XRP also increases. So while more people can buy it, it actually becomes harder to get at desirable prices or in large quantities. You also need to understand market psychology. Most people wait. They wait for confirmation, for price increases, for news headlines. But by the time those signals appear, the easy accumulation phase is usually over. This is where the phrase, "it will be very hard to get XRP," starts making real sense, not because it disappears, but because the conditions under which it was easy to accumulate no longer exist. Right now, we are potentially in that transition phase, the quiet phase where accumulation happens without massive attention, and historically, in every major asset cycle, this phase is where the biggest advantage exists. Once momentum kicks in, everything changes, liquidity tightens, spreads widen, and prices move faster than most people can react. So the key question is not whether XRP will be available, it will be. The real question is, will it be easy to get when everyone wants it at the same time? And based on everything we're seeing, supply structure, institutional interest, utility growth, and shifting market dynamics, the answer is becoming increasingly clear. To really understand why it may become very difficult to get XRP, we need to go deeper into something most retail investors completely overlook: supply shock mechanics. This is where the conversation shifts from simple price speculation to actual market structure. Because in reality, price is just a reflection of one thing: the imbalance between supply and demand. Right now, many people look at XRP and assume that because it has a large total supply, it cannot move aggressively or become scarce. But this is a surface-level understanding. What truly matters is not total supply, it's circulating liquid supply. And when you analyze XRP through that lens, the picture changes significantly. A major portion of XRP is held in escrow by Ripple. These tokens are released on a scheduled basis, and even then, not all of them enter the market immediately. This controlled release mechanism prevents sudden flooding of supply. At the same time, large holders, often referred to as whales, are not actively selling their positions at current price levels. In fact, data trends have repeatedly shown accumulation behavior during periods of low volatility. Now consider what happens when demand begins to rise, even slightly. In a typical market, increased demand is met with increased selling, but in a constrained supply environment like XRP, that balance doesn't hold as easily. If holders are not willing to sell, buyers are forced to compete at higher prices. This creates upward pressure not because of hype, but because of structural limitations in available supply. Another critical factor is utility-driven locking of XRP. Unlike purely speculative assets, XRP has a defined use case within liquidity systems. When financial institutions or payment providers use XRP for cross-border transactions, they temporarily lock tokens into operational flows. These tokens are not sitting on exchanges waiting to be traded, they are being used. And as usage increases, more XRP gets tied up in these processes, reducing the freely tradable supply even further. At the same time, exchange reserves play a huge role. Over time, there have been noticeable trends where XRP holdings on exchanges decrease. This usually indicates that investors are moving their assets into cold storage, a strong signal of long-term holding rather than short-term trading. When coins leave exchanges, they are effectively removed from immediate circulation, making it harder for new buyers to access them quickly. Now, layer institutional behavior on top of this. Institutions don't chase price the way retail does. They position themselves early, often during periods of low attention and low volatility. If institutions are accumulating XRP quietly, they are absorbing supply without creating obvious price spikes. This kind of accumulation phase is dangerous for late entrants because it gives the illusion that nothing is happening, until suddenly everything moves at once. We also need to consider liquidity fragmentation. XRP is traded across multiple exchanges globally, but liquidity is not evenly distributed. In times of high demand, this fragmentation can lead to slippage, wider spreads, and limited order book depth. In simple terms, even if XRP is available, it may not be available in the quantity or price range that buyers expect. Then comes the psychological trigger point. Markets tend to remain quiet until a catalyst appears. It could be regulatory clarity, a major partnership, or a shift in macroeconomic conditions. Once that trigger hits, attention floods in. Retail investors rush in, institutions accelerate positioning, and suddenly demand spikes within a very short time frame. This is where supply shock becomes visible to everyone. And here's the key insight. By the time supply shock is visible, it's already too late to benefit from it fully because the easiest accumulation phase has already passed. What remains is a highly competitive environment where buyers are chasing limited supply. So when we say it will be very hard to get XRP, we are not talking about it disappearing from exchanges. We are talking about a shift in market dynamics where access becomes restricted by price, availability, and speed of execution. The window where XRP is easily accessible under calm conditions does not stay open forever. Now let's connect everything to real-world adoption, because this is where the conversation around XRP becomes far more serious. Up until now, many people have viewed XRP primarily as a tradable asset, something you buy low and sell high, but the bigger picture has always been about utility, and more specifically, its role within global payment infrastructure being developed by Ripple. Ripple's core objective has never been to compete with retail cryptocurrencies on hype cycles. Instead, it is focused on solving inefficiencies in cross-border payments, an industry that moves trillions of dollars globally every year. Traditional systems like SWIFT are slow, expensive, and require pre-funded accounts in multiple currencies. XRP, on the other hand, is designed to act as a bridge asset, enabling near-instant settlement without the need for pre-funding. Now think about what that actually means at scale. If financial institutions begin integrating XRP into their payment corridors, they will need access to liquidity. Not just small amounts, but consistent and reliable liquidity pools. This is where demand shifts from speculative to operational. And operational demand behaves very differently. It doesn't panic sell, it doesn't react emotionally, and it doesn't exit the market during volatility. It stays because it serves a function. As more corridors open, whether it's Asia to the Middle East, Europe to Africa, or remittance-heavy regions, XRP starts getting embedded into the system. Every transaction cycle requires liquidity on both ends. Even if XRP is only held for seconds during a transaction, the infrastructure supporting those flows requires reserves. This creates a baseline level of demand that continues regardless of market sentiment. Another important layer here is partnerships. Ripple has spent years building relationships with banks, payment providers, and financial institutions. While not every partnership directly uses XRP today, the infrastructure being built is XRP compatible. That means when conditions align, regulatory clarity, cost efficiency, and liquidity maturity, switching to XRP becomes a logical step rather than a speculative one. And this is where timing becomes critical. Adoption does not happen all at once. It happens gradually, then suddenly. For a long period, progress may seem slow, almost invisible. But beneath the surface, integrations are being tested, corridors are being optimized, and systems are being prepared. Then, once a tipping point is reached, expansion accelerates rapidly. If that acceleration phase begins, demand for XRP could increase at a pace that the market is not prepared for. Remember, supply is already constrained in terms of liquid availability, so when real-world usage starts pulling from that supply, it adds another layer of pressure on top of investor demand. We also need to consider geopolitical and economic factors. Countries are actively exploring alternatives to traditional financial systems. Faster settlement, lower costs, and reduced dependency on legacy networks are becoming priorities. In such an environment, a digital asset like XRP, designed specifically for liquidity and settlement, becomes highly relevant. At the same time, retail investors often underestimate how quickly narratives can change. One major announcement, one confirmed large-scale use case, or one shift in regulatory stance can trigger a wave of attention. And when attention meets limited supply, the market reacts aggressively. This is why the phrase, "it will be very hard to get XRP," is not just about scarcity. It's about timing and positioning. Right now, access still exists under relatively calm conditions. Prices move, but they are still within a range where accumulation is possible without extreme competition. But if adoption accelerates, that environment changes completely. Another key point is that early adopters, both retail and institutional, understand this dynamic. They are not waiting for full confirmation, they are positioning ahead of it. And as more participants adopt this mindset, the available supply tightens even further. So the real takeaway from this phase is simple. XRP's value proposition is not static. It evolves as adoption grows, and as it transitions from a speculative asset to a utility-driven asset, the way it behaves in the market changes. Availability becomes conditional, not guaranteed. Now let's focus on one of the most underestimated forces in this entire equation, institutional capital, and how it can rapidly change the accessibility of XRP, because up to this point, most retail participants are still thinking in terms of small-scale buying and selling, while ignoring how large entities actually move in financial markets. Institutions do not operate like retail. They don't wait for headlines, they don't chase green candles, and they definitely don't enter markets emotionally. Their strategy is based on positioning, timing, and scale. When institutions identify an asset with long-term utility and asymmetric upside, they begin accumulating quietly, often in phases that appear boring or directionless to the average investor. This is where things become critical. If institutions view XRP not just as a tradable asset, but as a liquidity solution connected to the infrastructure being developed by Ripple, then their approach shifts from speculation to allocation. And allocation means size. We're talking about positions that are significantly larger than what retail investors can absorb or compete with. Now, think about the impact of that on market dynamics. If a few large entities begin allocating capital into XRP, they are effectively absorbing available supply over time. They don't need to buy everything at once. In fact, they prefer not to. They accumulate gradually, using algorithmic strategies that minimize price impact while steadily increasing their holdings. During this phase, the market often looks inactive. Price may move sideways, volatility remains low, and retail interest fades. But underneath that calm surface, supply is being redistributed, from weak hands to strong hands. This is one of the most important transitions in any market cycle, and it usually goes unnoticed until it's too late. Another layer to consider is custody. Institutions typically do not leave assets on exchanges. Once they accumulate, they move their holdings into secure custody solutions. This effectively removes those tokens from active circulation. So even though total supply remains the same, the tradable supply continues to shrink. At the same time, regulatory developments play a major role in unlocking institutional participation. For a long time, uncertainty limited how much exposure large financial entities could take in assets like XRP, but as clarity improves across different jurisdictions, those restrictions begin to ease. And when that happens, capital that was previously on the sidelines can enter the market. This is not a slow trickle, it can be a wave. Institutional capital moves in size, and when multiple entities act within a similar time frame, the impact compounds. Demand increases sharply, while supply, already constrained, struggles to keep up. We also need to address liquidity depth. XRP markets, like many digital asset markets, are not infinitely deep. Large buy orders can move price significantly, especially if there is not enough sell-side liquidity available. This creates slippage, rapid price increases, and a feedback loop where rising prices attract even more attention and demand. Then comes the behavioral shift in retail. As price begins to move, retail investors who were previously inactive start entering the market, but now they are entering under very different conditions. Instead of calm accumulation, They are competing in a high-demand environment where prices are moving quickly and supply is limited. This is where the phrase, "it will be very hard to get XRP," becomes very real in practical terms. Not because XRP is unavailable, but because acquiring meaningful amounts without significantly impacting price becomes difficult. Entry points become less favorable, volatility increases, and execution becomes more challenging. Another important factor is portfolio rebalancing. Institutions that allocate to XRP may do so as part of a broader digital asset strategy. If XRP begins to outperform or gain strategic importance, allocations can increase over time. This creates sustained demand rather than one-time buying pressure. At the same time, early institutional movers gain an advantage. They secure positions at lower price levels and with greater ease. Late entrants, even if they have more capital, are forced to operate in a tighter, more competitive market. So what we're seeing here is a convergence of factors: institutional accumulation, reduced exchange supply, improving regulatory clarity, and increasing utility. Each of these alone can impact the market, but together they create a powerful dynamic that shifts XRP from being easily accessible to increasingly difficult to acquire under favorable conditions. And the most important thing to understand is this: these shifts do not announce themselves in advance. They happen quietly, then reveal themselves suddenly through price action and market behavior. Now let's bring everything together and clearly understand what this entire narrative means for anyone watching XRP right now. Because when you combine supply constraints, real-world utility, and institutional behavior, you start to see a very specific pattern forming, one that has repeated itself across multiple asset classes, but is still largely misunderstood in the crypto space. At its core, the statement, "it will be very hard to get XRP," is not about fear or hype. It's about positioning relative to a shifting market structure. Right now, XRP still exists in a phase where accessibility is relatively open. You can enter the market without extreme competition, spreads are manageable, and price movements, while volatile, are still within a range where calculated accumulation is possible. But as we've discussed, this phase does not last indefinitely. As utility expands through the infrastructure being developed by Ripple, XRP begins to transition from a speculative instrument into a functional asset within global liquidity systems. That transition changes everything. It introduces consistent demand that is not driven by market sentiment, but by operational necessity. And when demand becomes necessity-driven, it becomes far more stable and persistent. At the same time, institutional capital does not wait for confirmation the way retail typically does. It anticipates. It positions early, often during periods of low attention. And once positioning is complete, the market dynamics shift quickly. Liquidity tightens, available supply decreases, and price begins to respond more aggressively to even small increases in demand. Now add the psychological component. Most participants enter markets reactively. They wait for price to move, for news to break, or for validation from others. But by the time those signals become obvious, the underlying opportunity has already started to diminish. This is where the gap between early positioning and late entry becomes most visible. If XRP enters a phase where adoption accelerates, institutions increase exposure, and retail demand surges simultaneously, the result is a compressed window of opportunity. In that environment, access is no longer defined by availability alone. It's defined by timing, speed, and willingness to act under uncertainty. Another key takeaway is that markets reward patience before they reward reaction. The quiet phases, the ones that feel uneventful, are often where the most strategic positioning happens. Once momentum builds, the environment becomes reactive, emotional, and highly competitive. That's when most people enter, and historically, that's when risk increases significantly. So when evaluating XRP from this perspective, the focus should not just be on price targets or short-term movements. It should be on understanding where the market currently sits within this broader cycle. Are we still in a phase of quiet accumulation, or are we approaching a transition into accelerated demand? Because that distinction determines how easy or difficult it will be to build a position. It's also important to remain grounded. While all these factors point toward increasing difficulty in acquiring XRP under favorable conditions, markets are never guaranteed. There are always variables, regulatory shifts, macroeconomic changes, unexpected events that can influence outcomes. This is why disciplined decision-making is essential. And that brings us to the most important part, perspective. Information like this is meant to help you understand potential scenarios, not to push you into action. Every investor has a different risk tolerance, different time horizon, and different strategy. What works for one person may not work for another. Financial disclaimer: this content is for informational and educational purposes only and should not be considered financial advice. The cryptocurrency market is highly volatile and involves significant risk. Always do your own research before making any investment decisions. Never invest more than you can afford to lose, and consider consulting with a qualified financial advisor before taking any financial action. At the end of the day, the idea is simple. Markets change, conditions evolve, and opportunities shift. The only question is whether you recognize those shifts early or after they've already played out.